I do not believe AI is in a bubble. That statement might surprise anyone looking at the explosive growth, the soaring valuations, and the unprecedented capital flowing into the sector. But when you peel back the layers, when you analyze the underlying cost declines, the breakthroughs in compute efficiency, and the pace of real-world adoption, one truth becomes undeniable. What we're witnessing is not a bubble, it's the early stages of one of the most transformative technological revolutions in history. People often confuse rapid price appreciation with irrational exuberance, but in my experience, bubbles come from speculation without substance. What's happening in AI right now is the opposite. We're seeing extraordinary innovation backed by measurable fundamentals, breakthroughs in model performance, declines in training costs, and exponential uptake across industries that once resisted technological change. When costs fall this fast, adoption accelerates, and when adoption accelerates, value creation compounds. That is not a bubble, that is technological inevitability. Look at history. The internet in the early 1990s wasn't in a bubble, it was misunderstood. The real bubble came later, when investors chased price without understanding productivity. Today, AI is in its 1994 moment. Early, raw, but undeniably powerful. Companies are not just talking about AI, they're restructuring entire workflows around it. Productivity metrics are shifting, time to insight is collapsing. Tasks that once required hours now take seconds, and we are still at the very beginning of multi-model intelligence, agent systems, and autonomous decision loops. This isn't a bubble. It's a platform shift that will rewire the global economy. What convinces me even more is the rapid decline in compute costs. Every innovation cycle in technology begins when prices collapse. With training efficiency improving dramatically and hardware accelerating faster than traditional roadmaps predicted, the cost to create intelligence is falling by orders of magnitude. That's the same dynamic we saw with mobile genomic sequencing and renewable energy. When prices drop exponentially, demand follows the same curve. It is the clearest signal of long-term sustainability, not speculative excess. And let's talk about where the capital is flowing. Investment isn't just chasing hype. It's targeting foundational models, compute infrastructure, data pipelines, robotics, and enterprise integration layers. These are not story stocks. These are mission-critical systems that corporations, governments, and institutions cannot function without. When Fortune 500 companies allocate budget and restructure operational processes to integrate AI, that's not euphoria, that's validation. We're also seeing a profound shift in the labor-technology relationship. Instead of replacing workers, AI is amplifying them. In many organizations, AI has become the equivalent of a digital teammate drafting, analyzing, reasoning, predicting. It expands the creative bandwidth of people across every level. Productivity leaps like this do not point to a bubble. They point to a long-term, compounding economic transformation. The skeptics worry about volatility, and they should. Game-changing technologies always come with intense volatility. But volatility is not a sign of a bubble. It is the natural byproduct of price discovery during periods of exponential innovation. The real risk isn't that AI is overvalued. It's that many investors are still severely underestimating the magnitude of what's coming. They're trying to evaluate exponential technologies with linear models, and that creates a massive disconnect between perception and reality. In every innovation wave, there's a moment when the mainstream narrative flips, when people stop asking whether the technology is real and start asking how big it can become. AI is approaching that inflection point. We're watching markets absorb the idea that AI will touch every sector from healthcare and finance to energy, manufacturing, and creative industries. And we're seeing companies with no traditional software DNA suddenly outperform because they embraced intelligence as their competitive advantage. So no, this is not a bubble. This is the foundation of the next industrial revolution. We are observing technology that will redefine production, reshape economic value, and unlock trillions in previously unreachable opportunities. The market doesn't fully grasp the scale yet, and that gap between understanding and reality is where the greatest opportunities always emerge. When I share a prediction, it's never about theatrics, it's about following the data, the cost curves, the technology trajectories, and the historical patterns that guide every major innovation cycle. And right now, those signals are flashing brighter than ever. We are standing at an inflection point where multiple disruptive forces are converging simultaneously, and the market is still dramatically underestimating what that means for valuations, productivity, and global capital flows. This is not just another economic shift. It's a reshaping of the entire investment landscape. And that's why the prediction I'm making today is massive, because the numbers support it. And the market is not ready for the scale of what's coming. For years, we've argued that exponential technologies don't move linearly, they compound. And we are now watching that compounding force accelerate across AI, robotics, energy storage, multiomic sequencing, crypto infrastructure, and next-generation mobility. Each of these sectors is undergoing its own S-curve transition. But what's unprecedented is that this time, all of these curves are overlapping simultaneously. When technologies converge like this, the outcome is rarely incremental, it's transformative. Productivity booms, prices collapse, and entire industries reorganize around the new cost dynamics. Take artificial intelligence. The decline in compute costs is accelerating faster than even the most optimistic roadmaps predicted. Every major breakthrough reduces the price of intelligence, which triggers new adoption waves, which then push demand even higher. This reinforcement loop is not hypothetical, it's already happening. And as AI becomes cheaper, more accessible, and more embedded into enterprise infrastructure, the economic impact compounds. The market still thinks of AI as a vertical. It's not. It's a horizontal platform that will touch every sector, much like electricity or the internet, but with a far faster adoption curve. Then there's robotics. The integration of AI into robotics is collapsing the cost of labor-intensive tasks. We're approaching a world where robots aren't just assisting factories, they're transforming supply chains, logistics, construction, agriculture, and even small businesses. When the cost of physical labor drops dramatically, productivity surges, margins expand, and entirely new business models become viable. Few investors appreciate how quickly this shift is unfolding, or how dramatically it will reshape global manufacturing and trade. Energy is undergoing a similar revolution. Renewable power, energy storage, and grid-level innovations are driving down the cost of electricity. When energy becomes dramatically cheaper, it ignites growth across industries that were previously constrained by high operating costs. AI, robotics, and data infrastructure all thrive on abundant energy. And because technology drives demand, the feedback loop strengthens once again. Markets are still modeling energy transitions using the frameworks of the past, but the real trajectory is far more exponential. And then we have crypto, which continues to be misunderstood by traditional finance. Bitcoin and blockchain infrastructure are not simply speculative assets, they are emerging as foundational components of a new global financial system. The combination of decentralization, efficiency, transparency, and programmable value is opening doors to innovations that legacy systems were never designed to support. In every innovation cycle, we have seen the same pattern. The earliest adopters are dismissed, the technology is underestimated, and then the breakthrough happens seemingly all at once. Crypto is following that exact pattern. So here is the massive prediction. The convergence of AI, robotics, energy storage, blockchain, and sequencing will not just grow these industries, it will multiply them. We are heading toward a period where productivity gains could rival those of the Industrial Revolution, but in a fraction of the time. Traditional valuation models simply cannot capture what happens when multiple exponential curves reinforce one another. The market will eventually adjust, but by the time it does, the majority of the upside will have already been captured by those who saw the signals early. This is not blind optimism. This is what happens when cost declines, adoption curves, and innovation cycles line up perfectly. We are witnessing a historical moment, one where technological convergence reshapes global GDP, redefines industries, and creates entirely new categories of winners. The prediction may sound massive today, but soon it will look obvious. When I identify a #1 stock, it's never about chasing what the market already loves. It's about isolating the company positioned at the center of the most powerful technological shifts of our time. The market tends to reward what it understands, but the most transformative gains come from owning what the market hasn't priced in yet. And right now, one company stands out because it is not simply participating in innovation, it is enabling it. It is building the infrastructure that every breakthrough, every disruptive model, every next generation application will rely on. That is why it holds the top spot. The beauty of disruptive innovation is that it compounds. Breakthroughs in AI fuel breakthroughs in robotics. Advances in energy storage accelerate autonomy. Improvements in cloud computing unlock entirely new business categories. But all of this depends on compute, massive, distributed, intelligent compute. And the company I consider the #1 stock is the one building the backbone of this new intelligence economy. It is not just selling chips or servers, it is architecting the environment where intelligence is created, trained, deployed, and scaled. That positioning is uniquely powerful. What gives this company its advantage is not simply technology, it's the ecosystem. Traditional hardware companies sell products, this one sells a platform. The deeper customers build into it, the stronger the moat becomes. That's why enterprises across healthcare, finance, manufacturing, and scientific research aren't just adopting its tools, they're restructuring entire workflows around them. When customers embed your infrastructure into their core operations, switching costs skyrocket and long-term value compounds. This company's leadership in accelerated computing is not an accident. It comes from a relentless commitment to pushing the boundaries of parallel processing, software integration, and domain-specific architectures. In a world where AI models grow by orders of magnitude every year, traditional CPUs simply cannot keep up. The shift toward accelerated computing is irreversible, and the company driving that shift stands to benefit from demand that could expand for decades. But what truly separates it from the rest is the pace of its innovation cycle. Every time it releases a new generation of hardware, it doesn't just increase performance, it changes the economics of AI. When performance doubles or triples while cost per unit of compute drops, entire industries open up. Businesses that previously couldn't afford advanced AI suddenly can. Startups gain capabilities that used to cost tens of millions. Scientific research accelerates. These cascading effects create more demand for compute, which then drives the next cycle of innovation. Few companies in history have been positioned at the center of such a powerful feedback loop. Another reason this stock earns the top spot is its expansion into new verticals. This company isn't content with powering AI. It is moving aggressively into robotics, simulation, digital twins, autonomous systems, and even computational biology. Each of these verticals represents a multi-trillion-dollar opportunity over time, and they all require the same core capability: accelerated computing. The company is positioning itself not as a supplier, but as an orchestrator of the intelligence revolution, and the market still doesn't fully appreciate what that means. Many analysts continue to value this company like a cyclical semiconductor firm. That framework is fundamentally outdated. This is no longer a chip company, it is the infrastructure layer for the entire global shift toward AI-driven productivity. It will capture value not just from hardware, but from software, cloud networks, subscription platforms, and full-stack AI pipelines. The reason my confidence remains so strong is that the addressable market is expanding far faster than traditional models assume. As AI becomes cheaper and more ubiquitous, demand doesn't plateau, it explodes. Every new model, every new application, every new breakthrough needs exponentially more compute. And the company best positioned to supply that compute becomes one of the most powerful forces in the global economy. That is why this stock stands alone. It sits at the intersection of every major technological revolution unfolding today. It is the catalyst, the enabler, and the accelerator of the next era of innovation. And while the rest of the market debates whether its growth is sustainable, I believe the real question is whether investors truly understand how early we still are. When I say something can 15x by 2030, I'm not making a bold statement for the sake of shock value. I'm pointing to a trajectory already visible in the data, supported by cost declines, adoption curves, and technological convergence that the market still refuses to acknowledge. The mistake most investors make is assuming the future will look like the past: linear, predictable, incremental. But exponential technologies don't follow that path. They scale, collide, and reinforce each other in ways that create growth far beyond what traditional models can comprehend. The most misunderstood opportunities are always those sitting at the intersection of multiple innovation curves. They don't just benefit from one trend, they benefit from 5 or 6 simultaneously. And the area I believe can 15x by 2030 is building the infrastructure for intelligence, autonomy, and digital value creation. We are witnessing the rise of a technology stack that will rewrite the rules of productivity and reshape global capital allocation. The market still sees it as emerging. I see it as inevitable. Most investors focus on headlines. They react to quarterly volatility, short-term sentiment swings, and market noise, but the real signal, the one that matters, comes from cost declines. Whenever the cost of a transformative capability falls exponentially, adoption follows the same curve. That's exactly what is happening in artificial intelligence, robotics, blockchain networks, and next-generation compute architectures. And the company or asset positioned at the center of these cost declines doesn't just grow, it compounds, scaling value at a pace most people underestimate. The engine behind this 15x potential is the collapse in the cost of intelligence. The price of training models, deploying them, and running complex inference workloads is falling dramatically. This unlocks entirely new markets. It allows startups to challenge incumbents. It unleashes automation in sectors that were previously too expensive to transform. And the leader in this space is not merely participating in innovation, it is accelerating it. Every new product cycle, every architectural breakthrough, and every leap in efficiency expands its total addressable market by billions, even trillions. Then there's the convergence effect. When AI integrates with robotics, productivity explodes. When AI merges with energy storage and renewable generation, grid intelligence becomes a reality. When AI and blockchain intersect, we get programmable value, transparent computation, and frictionless global commerce. These intersections are not theoretical, they are already emerging in real-world deployments across manufacturing, logistics, biotech, and financial infrastructure. And the organization at the epicenter of this convergence is positioned to capture outsized value from every one of these megatrends. Most analysts still insist on valuing these opportunities through traditional frameworks. They treat them as cyclical, as if demand will peak and fade. That perspective ignores the fact that we are entering a new era of compute-driven growth, one in which intelligence is the most valuable commodity on Earth. As intelligence becomes cheaper, more abundant, and more integrated, demand doesn't saturate. It accelerates. We're watching enterprise AI adoption move from experimentation to necessity. We're seeing robotics shift from pilot programs to full-scale automation. We're seeing crypto infrastructure evolve from speculation to utility. These shifts compound together. What gives me confidence in a 15x outcome isn't hope, it's math. When cost declines intersect with S-curve adoption and ecosystem lock-in, value creation becomes nonlinear. The companies or assets at the center of this dynamic don't just gain market share, they define the market, they become the operating system for the next economic cycle, they capture the outsized returns that only come from enabling foundational technological change. The real risk isn't that this prediction is too ambitious, it's that investors are still thinking too small. They're modeling exponential growth with linear assumptions. They're underestimating how quickly AI, autonomy, and decentralized networks will restructure global productivity. By 2030, the world will look radically different, and the winners of this transition will be those aligned with the technologies driving that transformation. This isn't about hype. It's about understanding where the world is going and realizing that the assets enabling this shift have far more room to run than the market currently believes.